Welcome. This is the Lifetime Cash Flow Through Real Estate Investing podcast. This is where you'll learn strategies to help you achieve lifetime financial freedom through real estate investment. Your host, Rod Khleif, has owned over 2,000 homes and apartments, and he brings experts in all aspects of real estate investment and management onto the show. Now, here's your host, Rod Khleif.
Welcome to another edition of How to Build Lifetime Cash Flow. I'm Rod Khleif, and I'm thrilled you're here. I know you're going to enjoy the gentleman we're interviewing today. His name is Chris Winterhalter, and he lives in Chicago, but has invested in the St. Louis area and has built a $5 to $6 million portfolio of 120 units there. And he's got a very interesting story. I'm very excited to chat with him, and I know he's also in the hotel rehab business, so we'll chat with him briefly about that as well. Hey, Chris, welcome on the show.
Rod, thanks for having me. It's great to be here.
Absolutely. So, that wasn't much of an introduction, and I know you've got a very interesting story. Can you take a few minutes and tell us who you are?
Sure. So I was born and raised in Cincinnati, went to the University of Cincinnati undergrad. I'm a Bearcat. I've always been fascinated with business and entrepreneurship, and my goal throughout college and right as I was graduating was to start a business at some point, over the next 2 to 3 years of starting my career. So I graduated in 2007 with my bachelor's and decided to move to California, and I wanted to get started in real estate kind of right when the crash was happening.
Oh, lucky you! You were on the right side of that timing. Anyway, continue.
It seemed like it. So I started my career and was just for probably 12 months or so, I was just reading every book, trying to talk to every person that had any connection to real estate investment, and really truly learn about the business. My plan initially was that I was just going to slowly invest, over 2, 3, 4 years, and then potentially go into some type of business. I didn't know if it was going to be real estate or start some other type of business after I got my footing in my career. And so over the course of those first 12 months or so, I learned a lot about real estate and decided to do a few deals in the Midwest.
More specifically, where?
In St. Louis. I was looking at St. Louis. Okay. I was looking at Cincinnati and St. Louis. And ended up doing a couple of wholesale deals as my first few deals, and bought a few rental properties right literally as the crash was happening. So I didn't really know fully what I was doing, but I was intent on learning everything throughout the process, asking a million questions to anybody that would be willing to answer them, leveraging the people that I was trying to put together on a team. But I was very green and young and inexperienced.
So let me get this straight. So you lived in Cincinnati, but you invested in wholesale deals in St. Louis?
So I was at California at the time. I ended up moving to St. Louis, and so I'll get to that. So I was at California at the time in San Diego, and so I did one successful wholesale deal and bought 1 or 2 rental properties, and I thought, okay, I think I can do this. I think I can leverage this, and I think I can scale it. So I decided to quit my job, pretty much right when Lehman Brothers was crashing, which most people thought I was insane. And I don't know if I would give the same advice to myself back then.
Guys, those of you listening, just forget everything you just heard, that last few seconds there. Okay, continue, Chris.
So then, after, I quit my job, I made sure I was young. I was very young. So this, this was 8 or 9 years ago. I decided to, I wanted to get into the multifamily space. So after I quit my job, I started to learn that this is difficult. Wholesaling deals requires not only money, but a ton of time to figure out how to get into the pipeline. Getting into the multifamily space isn't as easy as, everybody says it can be. It can require cash, and it requires a network, and it requires
Can I stop you for 1 second? I apologize, because you said wholesaling costs you money. Are you talking about the marketing side of wholesaling, or did you mean multifamily costs money?
Yeah, so wholesaling from the marketing side. So,
okay.
And it doesn't necessarily cost a lot, of money,
right.
But it can. I mean, if you want to scale it and build it into something to build a pipeline,
sure.
You can spend a lot of money on marketing costs, right? $5,000 a month plus.
Sure. To have a big operation, absolutely. The reason I bring it up is I think as a lead in to developing some cash flow, I'm developing some cash so you can invest in multifamily. It's not a bad way to go, but you're right. To have any big scale, you're going to spend some money. So sorry, and I didn't mean to interrupt, but I just wanted to make sure I was clear on what you meant there.
Sure, no problem. So, I started. This was, getting into the time where the short sale business was extremely hot. Right. And so I made some mistakes, but I did some things really well. And one of those was I kind of aligned with someone that was really good at handling the short sale piece, and we would go in on a 50-50 deal. I would attract the lead and get the lead converted, and then they would set up the conversion of the short sale. So that actually turned out to be what you just said, a really good moneymaker as I was entering multifamily.
Did you do that in the single? Obviously in the single family space, but was this in California still, or were you already in St. Louis?
So this was right before I was in St. Louis, and this person I partnered with was in St. Louis.
Okay.
And we did. It was mostly single families that we wholesaled. We did one or two small multifamilies. I think a 6-family unit that we did a short sale on that took a very long time.
And you wholesaled it?
No, we ended up buying it. So it was an approved short sale. We were going to wholesale it. We decided to buy it at the time. So,
good for you.
So starting my career, we were doing the wholesaling piece, and then I wanted to focus on multifamily. So maybe 6 to 12 months in to me starting the business after I quit my job, if you follow me, I met my current business partner who had an existing hotel construction company, and his construction company was really coming to a slow end because of the crash, and he wanted to diversify and get into investing in real estate. So he allowed me to be able to expand and really lay out a plan to invest in a handful of flips, so redevelopment projects, historic and non-historic flips.
So he was an equity partner. He had money and allowed you to go out and do some deals.
Yeah, so he had some money and allowed us to leverage that and into some redevelopments and flips, and then ultimately multifamilies. So we bought throughout the course of those next 2 or 3 years, we bought and sold a couple dozen houses, did some really cool historic redevelopment flips, learned that flipping houses can be a lot of work, very time intensive.
This was in St. Louis as well?
Yeah. Okay. So at that point, more or less, I was in St. Louis. So, over the course of those next few years, we bought and sold a handful of multifamily, not a handful of single families, and did a handful of historic redevelopments. We learned that flipping houses can be a lot of fun, but it can be come with a lot of challenges. And sure. We were flipping houses to end buyers throughout the beginning of the crash, which was very challenging. However, we really learned how to get the product priced appropriately and renovated appropriately for the market. So our average days on market were, I think, less than 10 days.
Great.
So,
let me interject something. So for my listeners, obviously when you're flipping, if you're selling to end buyers, the properties have to be in great shape. They have to be priced well and everything else. And now versus wholesaling, where you're dealing with investors, that it's all numbers and not as much of the attractiveness of the property if there's an opportunity for the wholesaler to make money. Flipping and wholesaling really is an excellent way. I kind of poo-poo it because I'm a big multifamily proponent, as it sounds like you're about to get into here, Chris. But flipping and wholesaling is an excellent way to raise money if you don't have any for your, well, not flipping, but wholesaling for sure, on a small scale, like we talked about a second ago, for raising money for your multifamily investing. So anyway, Chris, please continue. So you started looking at multifamily.
Yeah, so we started looking at more 10 and 20 unit buildings. We bought our first 12 unit building, and then continued slowly buying from then. What we learned throughout the crash, which was which was somewhat difficult, being new to the space, very difficult to form a small business relationship if you didn't have an existing relationship.
With who?
Sorry, for small banking
banks,
business relationship.
Right. Well, nobody was lending back then. I mean, it had locked up tight. And just so I have some clarification, were you still focused on the whole short sale model? So you'd go in and try to acquire these properties via the short sale, including the multifamily, or were you on the open market at that point?
No, we were on the open market at that point. So okay. We were trying to market to multifamilies as well, but found that to be pretty difficult and hit or miss for doing short sales with buildings that were between 1 to 20 unit. We found it better if it was a foreclosure property to get in there and negotiate for small multifamily, negotiate with the small bank, and either negotiate some type of financing terms with them, and or just a really solid deal where they might take a loss on that building. It was either a receivership. Go ahead.
No. That let me interject something there too, guys. Those of you listening, develop relationships with banks, because what he just described is an excellent way to get fantastic deals, and particularly in a contraction like the crash. And you guys all know, there's another one coming. It's some people say it's already started. Robert Kiyosaki was quoted as saying it's already started, but it is coming. And when that happens, banks are going to obviously end up with a lot of assets again, and they're not in the property management business. And if you develop relationships with these bankers and you can solve their problems, like you just said, Chris, you actually got deals where they offered you financing directly from the bank. Is that what you were saying?
Yeah, and this was pretty common depending on the borrower on small multifamilies, because these banks, especially on the small multifamily side, they were difficult to work out, right? You didn't have generally a professional property management business handling that at 50 or less units. On a bigger building, there might have been a professional management or a receiver that appointed one. On smaller buildings, much different.
Right. And guys, so that's a real challenge for a bank, because how do they stabilize the property? So if you come in, and as a perceived expert, to be able to take that and fix their problem, I mean, you're the go-to guy, and that can be the gift that keeps on giving, particularly in the market circumstances that you were in back there, Chris. So please continue. Sorry.
So I will say, though, that forming that first small bank relationship was difficult. So we probably talked to, on our first deal that we bought, we purchased it with private money, a private investor that we had networked with, and he had very favorable terms. I would be lending money right now on those terms back then, but we were getting started and we needed capital, and the numbers made sense from the purchase.
In other words, you paid a very high interest rate.
Exactly. Okay. So, but it actually made a lot of sense on the deal side, so it penciled out.
Absolutely. I put houses on credit cards back in the day, 18% interest. I mean, when you're buying something for $20,000 that rents for $500 a month, it's kind of a no-brainer back then. But anyway, continue.
Yeah, so we found ourselves, after we rehabbed and stabilized this property and working to get that first small bank relationship, we probably called every single bank in the market, and finally had a few that returned phone calls. One that provided a term sheet after kind of a lengthy back and forth. And then that first deal, that second one became so much easier.
Sure. Amazing that you found one that was even lending back then, because it was so locked up. It was crazy. So you really had to work for it. Wow.
Yeah, and it took us several years because they wanted to see, we bought a very distressed asset, which was the reason we got a discount.
Right.
And they wanted to see it more stabilized
Sure.
than they even originally said, because went through underwriting the first time and got turned down, and then we had to wait another 12 months.
Because you got turned down on the acquisition money for this property?
No, on the refinance.
Refi.
Acquisition was all through private money, and that's what we were acquiring everything with, was really private money.
Oh, I see. Okay, all right, got it.
Throughout the crash. So, long story short, we continued investing in multifamily, and a few years ago decided to grow our hotel arm as well, which is a different story. And 2 years ago, we purchased the last deal that we bought, which was a 60-unit building, and we've been a little cautious over the last 2 years. A year ago, we backed out of a 70-unit building that we had under contract because of kind of some major issues during due diligence.
Well, I'd like to dig into that in just a second here, but I want to mention one thing. Chris talked about the bank requiring the property to be stabilized, and guys, what that typically means, it's usually a rough rule of thumb. It's typically 80% occupied, but in some banks it can even be 90% occupied. So that's what stabilized means. And so let's dig into your. Can we talk about the 60 unit that you bought? Can we dig into that acquisition a little bit?
Sure. Okay. So all of our multifamilies are more or less within a mile radius. So, which is great. We have an excellent relationship with the property management group that is almost like our direct partner that, I think we would potentially acquire if it came to that, just because we've had this long-term relationship. And the 60 unit was kind of right in the middle of our other properties. It was a situation where the seller was retiring, and they kind of just wanted to get out.
How'd you find it?
It was through a broker contact that sold us another deal, and so wasn't really listed. It was just kind of one of the backhanded type deal.
Pocket listing.
Yeah. And so we got in there and found out that it had a lot of deferred maintenance, and negotiated a deal that worked out. Ended up working out really well. And
can
part
you be
of
more
that,
specific to talk about what you negotiated?
Yeah, so we came in and we negotiated a 10% seller second that they would carry back for 5 years at 5% on the seller second. We got our bank to agree to that.
As part of the equity?
Seller second. Yeah, exactly. It's part of the equity. So we only had to put up 10% for the deal.
So you got an 80% first mortgage. You got the seller carry 10% as part of the 20% difference. You only had to come up with 10%. It's fantastic, guys. I hope you guys are taking notes on that. That's a very creative way to get into a property, minimal down. Fantastic.
And they wrapped in our rehab financing. So
fantastic. So they the 80% plus the rehab?
Yeah, so essentially they took it was 80% after repair value, and they wrapped in 80% of both the construction costs and the acquisition costs.
How much was your CapEx on it?
I believe we were at, I think, $350.
Wow.
Maybe.
And they financed that for you guys. So basically what he's saying is they took as the value of the property, a bank will typically take the purchase price. And I assume because you had a great relationship with this bank, they agreed to use the after repaired value and use that as the value, and then take 80 and then give them a loan on 80% of that and allow the seller to carry 10% of the down payment. It's very creative, very aggressive, frankly, on the bank's part, and a fantastic deal for you guys. Good job, Chris. Wow.
Yeah. And that was really based on a previous relationship that we had.
No question. No bank will do that out of the gate. No way.
Yeah. Exactly. And I think our closing costs were $1,000. Our origination fees. So the bank fees.
They really took care of you. Yeah, that's very unusual. It's usually quite a bit more of that. In fact, typically 10 times that. But let me mention one other thing, Chris, because I like to interject things that the listeners may not pick up on. And one of them is, guys, he got this deal because he had a relationship with a broker. And I know you've heard me talk about how important those relationships are. Those relationships will make you wealthy. Nobody else knew about this deal. He was the only one negotiating on it because he had a relationship. So please, take note of that. All right, Chris. So that was the 60 unit. And how's it doing now? How's it performing?
So it's doing well. It takes a long time to stabilize the property. So in a value add situation, we have a lot of deferred maintenance. We had a plan. We put together a plan on essentially a tier of tenants that you want to replace. Sure. Tier 1, most important, mission critical. These people have to go today. Tier 2, Tier 3, Tier 4, and so it takes a long time to cycle through those tenants. We also had to hit every single unit, and we had to redo all the plumbing waste and supply in the building. So while it was occupied.
Oh, so you did that while they were all in there. Wow, that's a big job.
So we moved, and we had done this previously with the 16-unit building, but we essentially, the good tenants, we relocated them.
Sure.
And either whether it was a temporary situation or a permanent situation, we would get into a renovated unit and then move them into a nicer unit. Obviously, that's a win-win for them.
Sure.
And a win-win for us. They sign a new lease. We raise their rent a little bit. And so, I believe we've been at 93 or 95% for I think the last 6 months or so.
Fantastic.
And it's doing well. I will say, we knew, so the bank covered a very large majority of the rehab costs, but we knew we had
carrying costs.
Yeah, we had some carrying costs. We also had some other deferred maintenance that we knew we were going to have that we had to just creatively get through. So, we over the first year or so, we invested probably another $50,000 into it. We believed and we knew that investing that money was going to pay off on the long term. So that's really been where it's been.
So what was the ultimate purchase price of that property? The initial purchase price?
I believe it was 1.6.
Okay, and then you put 350 in. You had 350 in capex. So you're basically in it for almost $2 million.
Correct.
And now what do you think it's worth stabilized?
So I was just a while ago, I was talking to my broker about it.
Do you know what the NOI is?
I think it's 2.5.
2.5. Okay.
Yeah, maybe a tad more.
Yeah.
I'd have to look at our NOI numbers, but really it's maybe a 7.5 cap deal.
Okay, so do you know what your NOI is? That's net operating income, guys. That's the difference between gross income, less expenses. That's net operating income, and it does not include debt. Do you have any idea what it is? I'm kind of putting you on the spot here. If you don't, it's fine. I was just going to do the calculation to show my listeners it's not a big deal if you don't have it.
Yeah, I think we were. I have to look back at my numbers. I don't have it off the top of my head.
No worries.
Yeah.
Okay, so and basically, guys, what I was going to do is I was going to take his NOI, whatever it is, let's 100,000, 200,000, whatever it is, and divide it by that cap rate, that's 7.5%, and that'll give the current value. So that's just an aside. Okay, so let's talk about the deal you didn't do, if you don't mind. You said it was a 50 unit, or was that right?
It was a 74 unit.
74 unit. Okay. And so how'd you find that one?
So we found it through a broker relationship as well, and it was a distressed, similar situation, distressed deal, a seller that was retiring, just had left the property in complete disrepair, and needed also a lot of CapEx, but even more. And so the deal, as you know, the multifamily market has heated up a lot. It's been hot for a long time, but especially the last 3 years or so. And so, we had the deal under contract, and I will preface this with saying that we had always prided ourselves, whether we were buying a single family or a multifamily, not getting a deal under contract and backing out.
Right. So, and guys, let me interject that. Guys, you do not want to do that to brokers, okay? So you need to do your preliminary due diligence and evaluate it as much as you possibly can before you put it under contract. And then, then you better have a reason for backing out if you want to maintain that broker relationship, i.e., that you didn't have all the information, or the information that was given to you wasn't accurate. So, okay, so I just want to interject that, Chris. So anyway, you put it under contract.
Yeah, so we put it under contract, and then, we went through our inspections, walked through, put our plan together, and during that first couple weeks, we were raising our capital. So we had our capital pretty much raised rather quickly on the equity side of it.
Were you doing a syndication, or was this private? Was this just you and close people?
Yeah, so it was just one main investor.
Okay, all right. So
and then we were putting in some of our money as well.
Okay.
And so we laid out the plan for the property, and when we got in there were some foundation issues that really pushed that rehab number up. And we really wanted to close on the deal. However, it was essentially throwing us off $200,000 on the deal.
What was the purchase price you had it under contract for?
I believe we had it under contract for 1.9.
Okay, so it was about a 10% swing. Okay, that's a big swing.
Yeah. And so, we were figuring we had to put, I believe, 400 into it, and so another 200 really put us over. And here's where the 200 were a couple things. One, we didn't believe we were going to get the value out of the deal. Two, it was going to hurt our financing side on the debt side. So, meaning...
Hurt in what way, yeah?
Hurt in what way? Meaning we would have to raise more equity because the bank was not comfortable with the value with the additional rehab amount. And so they would have been... We probably could have got the deal done by, laying out a plan to tear back the rehab. However, it would have just been a maintenance hemorrhage over 5 years, which what happens, obviously, is it just burns cash flow. You either only pay your investor or investors, or, even worse, you might be short on paying your equity side.
Yeah, and that doesn't bode well with your investors, guys. That's why you want to be very conservative in what you tell your investors, because if you have a situation like Chris describes here, and you're telling them they're going to get an 8 or 10% return preferred, and they don't get it. It's always better to underestimate. And by the way, I want to interject something, guys. I know we're talking about some advanced stuff here, and my book is almost done, I promise. And those of you that haven't heard me talk about it before, it's 200 pages long. It's like a play-by-play on buying real estate. It's called The New Rules of Real Estate Investing, a comprehensive guide to multifamily investing, and it's really like a textbook. And I'm giving it to you guys for free. So if you want it, text Rod to 41411, and I'm literally a week or two away from sending it out. So make sure you get a copy, because after the first of the year, it's going on Amazon, and then I'm going to charge for it. And it describes a lot of these things that we've been talking about, like retrading a deal or backing out of a deal that you've got under contract, and why you don't do that, and a lot of other things that will help you in understanding what Chris and I are talking about. So anyway, so it just didn't make sense. The deal didn't make sense, and then you had to back out, and that is what it is, I guess.
Yeah, and obviously, we didn't want to go into the deal, and even if pay our investors happy. These deals take a lot of time, a lot of investment on our side. So going through a deal over 5 years, And also, we do believe there's going to be another dip in the market.
Oh, no question. It's coming.
And so we didn't want to get ourselves into a situation where we were going to be so tight on cash flow and we would hit a dip in the market, which would be, it would be a loss for us, even if we come out ahead, or even if the investor is paid. And
you're not in the charity business in this as it relates to this part of your business. And,
exactly.
You're not there just to work for your investors. You're there to make a profit. So no, I get it. So let's shift gears for a minute. A lot of the guys that listen on this show are brand new, and what advice would you give them as far as getting up to speed on this business? You said you read a lot of books and things like that. I mean, what advice would you give a newbie?
Yeah, I think it depends what their goals are and how they want to invest. Either as supplementary to their career, or if they want to do it full time. I think that's different. I think if somebody wants to be a full time investor, depending on where they are in their career, that they can pick a profession that aligns with real estate in some sort of fashion.
That's a good advice. And you guys have had me, had listened to interviews with people that started out that way. They got it and they became a broker, or they were a property manager or whatever. That's great advice, Chris. So keep going. I cut you off, but I wanted to mention that because that is really, I want to put an exclamation mark on that.
Yeah, and I mean it's also a real estate attorney. I mean there's so many different things that tie into real estate that can give you a competitive edge. Investors, equity partners, investment partners want to know that you have a specific skill set that brings a competitive edge to the deal. And by bringing that, you need to be able to really be an expert in at least one section of the deal.
Or have people on your team that are. So you can supplement what Chris just said here. I don't want to discourage you guys if you're not in that business, because you can add people to your team that take care of your deficiencies or your inexperience. You bring a sponsor in initially or whatever. But yeah, the real estate attorney, that as well. I interviewed a guy that was a real estate attorney. He's got a few $1 million worth of assets now. I don't remember his name off the top of my head, but yeah, no. So, but what you said is absolutely right, Chris. The investors want to know that every aspect of the business has, an expert involved, from the acquisition side to the management side to the finance side, all of that. That's good.
And Rod, like you said, you can't, if you're not an expert, you can pull together a team of experts. However, at some point, you still either have to source the deal or have the relationship to source the deal, or provide something outside of just saying there's a listing online. Will you fund this deal because I think it's a good deal?
Oh yeah, no, you have to have the knowledge, no question, question. Yeah, and so. You just went out and read books and did this, or did you have a mentor? Did you, is that how you self-learned?
I self-learned a lot. I would say I had a handful of mentors. Not one single person. I leveraged a lot of the market. I learned by doing.
Good for you.
The team, building a team teaches you a lot too, because that team teaches you a lot. You have to treat people well. You have to be able to offer your team something as well, right? But
of course.
If you build a team, you treat them well, they will teach you an immense amount. And really, I wouldn't necessarily always recommend this, but I learned a lot by doing, and I made a lot of mistakes.
That's how I did it too. You make every mistake when you do it that way. Oh, that's great, man. That's great. I did it's the exact same thing. It was fire, and then think about aiming and getting ready. That's awesome.
And it happened to work out really well. So it's, when I look back, I'm glad that I made those mistakes. Right. Because, some of those mistakes, today I wouldn't necessarily make the same decisions, which I think would have ultimately ended in me taking maybe slightly less risk,
But it would have slowed you down. It would have slowed you
exactly.
down. And I'll tell you guys, and I know there are those of you that are listening that are in cotton analysis paralysis. And I talk to you guys when you call me in these calls that I have with you guys. And some of you are like I was, and you just want to go, but you don't have the practical knowledge. And the other ones have all the practical knowledge and don't take action. And you really need both. And when I talk to you guys on the phone, I tell you typically there's two things you need to be doing. One, you need to do what Chris did and self-study or take a course or read the books simultaneously while you're looking at deals. Be out there kicking the tires and talking to brokers and developing relationships and honing your competence, which builds your confidence, which will ultimately build your intuition. So literally you'll get to a point where you look at a deal and your gut will tell you something's wrong. And so, you have to do both. And that ties into my next question, because I do a clip every week called Your Driving Force Success Tip, which is all about taking action, getting past your fear, goal setting, motivation, helping people find their drive and taking action. So my question to you, Chris, is what makes you jump out of bed every morning and to go kick butt?
Yeah, so like I mentioned, back to the beginning of my story, I've always been passionate about business and entrepreneurship. Right. I want to build something that is large. I want to be a part of something that is big. And I love creating. I love building. And to me, I am extremely goal-oriented and continually, year after year, month after month, pushing to reach and go beyond those goals is what gets me out of bed. And, I have a lot of dreams as well aligned with goals. And, ultimately those dreams are, what you're excited about. And some of those dreams are professional and around business, and some of those are personal as well. And so, keeping that machine going and dealing with long hours and, dealing with the losses along with the gains can be tough, but, ultimately staying laser focused on those goals, knowing what I want, and then getting up and doing it every day.
Great advice, guys. Yes, and that's why I tell you goals are so important, because when you get knocked down and bloodied and beat up, if you've got your goals and you know why they're important, you just get up and you change your approach and you keep going for the goal. And you get knocked down again, you get up, you change your approach and you keep going for the goal, and you just repeat until you achieve it, and you will achieve it. And that's fantastic that you articulate it that way, Chris, because that is absolutely why you're a success. Last little thing I want to ask you, if you would be willing to share a war story where you got your butt kicked and bloodied, and a victory story that have occurred in your career, maybe the takeaways from them.
Sure. So back when we were flipping houses, we had aligned with, or we're starting a partnership with, I was actually an ex-NFL player, and they had essentially sold that they had the ability to bring a large amount of buyers. So they were going to be essentially the agent, the broker on the retail side.
A little misrepresentation then.
Yeah, and they tried to connect both, the sell side and the buy side of the deal. So they would find the deal, they'd find the person that would want to buy that deal, and then we would help renovate. We would buy the property and redevelop it, renovate it to the buyer standards, and then sell it to them, all kind of in a contractual piece. Well, the first deal that we did together, we learned that the integrity was lacking on the other person's end, and we had essentially had the whole deal somewhat fall apart mid-deal. We had to replace the contractor. We had to take over the entire deal. We had to essentially kick this agent or facilitator that was stating they were bringing the buyers and throw them out of the mix. The buyer that they had brought was not qualified based on what they presented. And so we got in there, fixed the deal, turned it around, and then put it on the market, and essentially lost, $15,000 on the deal.
Wow. So what did you learn? What was the takeaway?
So the takeaway was that getting into business, no matter if it's somebody on your team, a partner, you have to be extremely careful with who they are. So the vetting process needs to be in depth, and you shouldn't take it lightly. And not that we didn't, we maybe didn't cross all our T's or dot all our I's, but we weren't necessarily sloppy about it.
Sure.
But we weren't as in depth as we needed to be. And
Let me ask you a question. Did your intuition, if you really think back on it and honest with yourself, did your intuition possibly tell you there could be a problem, or no, he was that good?
I want to say that I have excellent intuition and I'm an excellent judge of people, because I feel like I am. However, in this position, myself, my partner, the team completely, did not see it.
Sometimes you ignore it, though. Sometimes the deal, it sounds so good that your gut's telling you, but you push through anyway, and you typically always regret it. That's why I asked the question. I did a piece on intuition, and I know, there have been times where, it just sounded so good. My gut said no, but I did it anyway, and I regretted it, and that's why I asked the question. Anyway, okay.
So I guess, if you're truly honest with myself, there was a piece of it that I felt that maybe it was a little too good to be true. Okay. The interesting piece that I think was overshadowing that was that, this person is well known in the community, he's a part of charities, and that all this possibly can't be the case, right?
Right. So you guys heard that. Even you did have an inkling something could be wrong, and trust that. No matter how everything looks on the outside, trust your gut, because it's incredibly powerful. So how about a victory story, buddy?
So,
or maybe it's the one you told us about, the one you turned around. I don't know, but
so maybe twofold. So we two short stories. So one, our portfolio, we don't have a single equity investor involved anymore. We've bought them out. We have refinanced, so we own our portfolio outside.
Congratulations! That is absolutely fantastic. That is such a great feeling. I did the same thing with hundreds of houses back in the day. That's awesome.
Yeah, so that's a big plus. The other side is that this year on both in our construction and real estate, mainly this number comes from our hotel business. Mm-hmm. We'll reach 12 or 13 million in revenue, and so that's a big goal for us. And
congratulations!
We're going to continually push that.
Awesome. That's absolutely awesome. Hey, Chris, thank you so much for your very valuable time. It's been a lot of fun. You've definitely added a lot of value. We got into some stuff that we don't always get into on the show, and I'm very, very grateful to have you contribute to my listeners.
Yeah, Rod, thank you very much for having me on the show. I will tell you, I did look at my number. We almost hit 200,000 in NOI on the 60-unit building.
So 200,000. Okay, hang on. So we take 200,000. So guys, that's his net operating income on that building we were talking about, and we're going to divide that by 0.075. So it's 2.666 million is what it's worth. It's pushing 2.7 million. Great job on that one, Chris. That's awesome.
Thanks, Rod. Appreciate you having me on the show, and look forward to listening to it live.
All right, thanks, Chris. Talk to you later.
Thank you for listening to the Lifetime Cash Flow Through Real Estate Investing podcast. If you've enjoyed the show, please subscribe and then take a moment to visit iTunes and leave a 5-star rating and review. For more resources to connect with us further, please visit our website at lifetimecashflowpodcast.com. Tune in next week for our next show.